All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another episode of Current Market Insights. I'm your host, Kieran O'Brien, and with me again this week is Mr. Peter O'Malley. Peter, good evening.
G'day, Kieran. Great to see you.
Great to see you, Peter. I want to kick off this week just talking about former RBA Governor Lowe has made headlines again. I saw today he's got a new job, and he thought at the same time he might talk a bit about what's happening in the Australian economy. Did you get a chance to have a look at what he said and any sense of what that means for us?
Yeah, as reported by the Herald, former Reserve Bank Governor Phillip Lowe has joined the chorus of voices warning that stubborn inflation could lead to interest rates staying higher for longer than many expect. World's most famous banker, Jamie Dimon, is in Sydney this week, Kieran. He has had a similar message, both for US interest rates and Australian interest rates. And Peter Costello was in the news this week as well. And he said that equity markets seem to have baked in interest rate cuts already, and markets may have run ahead of themselves. And what if the forecast rate cuts don't happen in the fashion that the markets have anticipated? You know, we could be headed for a bit of a correction there. So that was one of the points that we put in our January newsletter, is there was such a belief that interest rates would be forthcoming, that it would be interesting to see if buyers, both in equity markets and property markets, bake those rate cut expectations into their behaviour. There's many economies falling into recession around the world, and their stock markets, including Australia's, which is not in recession, is hitting all-time highs. So that would suggest that the market's front-running the interest rate cuts and driving stock markets to all-time highs, and property markets aren't far off it either. And there are some record prices happening around the city in the property market, and they tend to be at the higher price points, as we've previously discussed, but there's no doubt that many people are acting as though rate cuts are a given.
So we touched on, maybe 3 or 4 weeks ago, I mentioned that one of the major banks had already forecast some rate cuts into their decision-making, and in fact had brought down fixed rates in line with where they thought rates would go. Off the back of these comments, particularly from Jamie Dimon, who, with JP Morgan runs a huge bank in the US and is obviously at the forefront of financial markets and their impact on property in particular, do you think that we are likely to see the RBA respond with rate changes sooner than we had initially predicted?
I personally don't believe so. I think that the economy is still ticking over. Unfortunately, there's many people that are adversely affected by the current rate setting. But I think if you look at the overall economy and where the inflation rate's at, I still think it's a bit too high for comfort. And if they did cut rates too soon, they could cause another inflationary outbreak. I think that's the fear that all central banks would have. A great point that was made this week by a gentleman by the name of Cameron Kusher, who's an economist at realestate.com. He put out there on social media, what are the chances that as the RBA cuts rates, that macro-prudential policies are tightened further if property prices continue to rise? So what Kusher's suggesting there is that when the RBA does cut rates, they want those rate cuts to flow through to the pain areas of the economy. What they won't want to see those rate cuts do when they do come is stimulate property prices higher at a time we don't need higher property prices. So they may actually introduce tighter lending standards, just manufacturing them to ensure that they keep the property market subdued. Now, nobody knows if that's what will happen later in the year, but I think it's a really, really good point to raise at this stage of the cycle. And it's such a good point to raise because the RBA and APRA have got form for acting in unison like this in the past.
So a couple of things to touch on there. Cameron Kusher's comment about the lending changes or potential lending tightening. We've talked at length before about the serviceability buffer being the primary tool that the banks have. Is that likely to be an avenue of attack should they decide to actually regulate the lending sector a little bit further?
Oh, that is one way that they've attacked it in the past, Kieran. Another way they've attacked it is that they've forced the banks to charge a higher interest rate for investment loans than home loans, for example. Essentially, when you're looking at policy tightening, you look at where the market is most exuberant and you just invent a policy tightening of some description in order to keep the market subdued from overheating for its own good. So I wouldn't speculate at this stage what the exact change may be, but look out for APRA acting in unison with rate cuts in the RBA later in the year and coming up with a tighter monetary policy.
Yeah, good point, Peter. You also mentioned there that one of the things they don't want to happen, obviously, is to see a surge in property prices when rates do come down. What do you think will happen, though, if the RBA say, look, in fact, inflation is so much stickier than we thought it might be, and they are forced to make another rate rise before we finish out 2024?
That'll be very painful for a lot of people. I guess it can never be ruled out, but it doesn't seem to be on anyone's radar. Depending on who you talk to, there is a suggestion that inflation may win the day here, where central banks are forced to cut rates before they've won the inflation battle, meaning that inflation will potentially stay higher for longer and more persistent. Hardheads in this space like Phillip Lowe, Jamie Dimon, Peter Costello are not suggesting that's the case, and that the RBA and the Federal Reserve in the US will break markets if they have to get the inflation story under control. But one thing that everybody does seem to have discounted at the moment is there will be further rate hikes.
So given the scenario that we are in right now and the cost of living pressure that people are under, it seems to me that it's fairly reasonable to say, though, that if the RBA decide not to cut rates anytime soon, that may as well be as good as a rate rise in many cases. For a lot of people that are living potentially on the edge of the mortgage cliff and are facing real financial stress, time is their rate rise, effectively, in my mind anyway. Is that reasonable?
How I think an economist would phrase it is that the current interest rate setting is restrictive at its current level to clamp down on aggressive speculation in the property market and overspending in the economy.
Before we wrap up this part of the conversation, I'm interested to get a sense from you, given that there is a lot of talk about the strength in the economy still, there's sticky inflation, but there's certainly money out there in the property sector. How are you finding conversations are on the ground with buyers at the properties that you are selling in terms of what kind of decisions they're making, what kind of stress they might be under, and how positioned they are to actually, act on property at the moment?
Well, Sydney house prices for the last 12 months to the beginning of March are up 11.7% for the year on CoreLogic's numbers. And over the same 12-month period, apartments were up 7.8%. So home buyers have got a lot of confidence in the Sydney property market, particularly with the immigration story creating additional demand on essentially no new supply. So there is a confidence amongst home buyers that if I buy a property and I need to sell it for whatever reason, whether it's a change of plans, a job transfer, or I can't afford the property, there'll always be someone there that can take the property off my hands, because let's face it, the property market had a fairly sharp downturn after the boom, that downturn being in 2022, but it's bounced back really, really strongly in the last 12 months. And whilst the market had a sluggish start to 2024, the transaction rate is actually fairly strong at the moment, particularly given we're seeing listing volumes up 30% this year on the same period last year. So there's a lot of people out there buying real estate at the moment.
Yeah, there certainly is. And if I could sort of bring it all together in a bit of a summary, I view this as an interesting time in the market because we do have multiple factors at play. But as you say, we've also got an environment where we may see lending tighten. We may see changes to perhaps the way investment loans are delivered out and the access to money for people who are looking at potentially investing.
But that would only be in unison with rate cuts, yeah.
Of course. But to me, it's a potential change to the buyer demographic out there, and hopefully we may see a bit of a redistribution of owner-occupiers in the market to help offset some of the 680 or maybe 700,000 new people that have come into the country this year alone.
Yeah, well, most of those people do start off or begin life in the rental market. As we've previously discussed, Australia had more millionaires move to the country than any other country in the world last year. That was at a time that our currency is fairly depressed. So when you've had more millionaires move to your country than anywhere else in the world and your currency is depressed, it's unsurprising that those new entrants into the economy are going to make themselves felt in the property market, which is exactly what's happened in the last 12 months, and they've made their presence felt, that's for sure. How sustainable that is will depend on where interest rates go from here, how buyer confidence performs, and how the economy performs. And that's why I said earlier in the year that I don't think the RBA can be one of the first central banks to cut rates, because if they do, they'll send the currency lower, which will fuel overseas money a lot more at a time that we actually don't need any more overseas money buying our prime assets underneath our nose.
Absolutely. And as you mentioned previously, Peter, we've also still got some of the lowest or one of the lowest cash rates in the world. So we're actually not sitting as an outlier at the top of the pile here and needing to come back into line. I wanted to shift the conversation a little bit towards understanding the listing cycle. And we've talked very briefly in the past about, trends and seasons and the cyclical nature of real estate. But given we're talking about a period with increased listing volumes, I thought it might be good just to get a very quick recap on what the primary seasons or cycles are in real estate, particularly in Sydney, and what you think or how you think they're going to play out for the rest of this year anyway.
Well, there tends to be 5 unofficial cycles, Kieran. The first is the New Year listings, which is where we're at the moment. And that's the Australia Day to Easter listing cycle, and that's always a particularly strong one. The New Year listing cycle is probably, in terms of volume, second highest to spring. There's no doubt that this New Year listing cycle is higher than the same period last year, as discussed, by about 30%. More listings on the market this year. Once we get through Easter, which falls over the end of March and the beginning of April this year, we come into what we call the post-Easter autumn market, where people do see winter coming and say, hey, my house doesn't present so well over the winter. The weather is very pleasant in Sydney over autumn, as we know. So let's get a sale after Easter and before the winter chill sets in and the garden looks depressed. So that's another good listing cycle. Probably the flat spot for listings, not sales necessarily, but the flat spot for new listings is the winter market. As we know, there's a tendency for vendors to avoid that time of year. The funny thing is that because listings tighten so much over the winter, that can create some strength in the market, because buyers find themselves competing for less stock than what they normally would be. Obviously, coming out of the winter, we hit the spring market, which is most sellers' preference. We find each year that clearance rates drop and days on markets blow out during spring because too much stock comes to market together. And then there's the fifth unofficial cycle in the market, and that's what we call the pre-Christmas market, where people look at the calendar in early November, mid-November, and say, hey, instead of selling early next year, I think I'd rather wrap this sale up before Christmas. Call a couple of agents and see if they've got any buyers on their books that would buy this leading into Christmas. And the pre-Christmas market sees more transactions than a lot of people imagine. People think the property market sort of finishes up, in the first week of December, but agents will continue selling properties right up until Christmas Eve. And one of our agents last year actually sold a property between Christmas and New Year Eve, just to show you that if there's a willing seller and there's a willing buyer, a property can happen at any time of the year.
Yeah, there's always a deal that can be done. I'm interested to get your thoughts. Given the increased listing volumes we have seen to start 2024, I'm really interested to get a sense of what you think is going to play out in the winter, which is typically, as you've just said, a lower listing period, and also what's going to happen in the spring, given, as I say, that we have such a strong volume of properties on the market at the moment.
Yeah, well, look, there seems to be about 1,300 properties going to auction around Sydney each weekend at the moment, which parallels with the average of 800 a week for this time last year. You got somewhere in the vicinity of 500 extra properties a week going to market at the moment. Now, is that seller demand that's come forward because there's some interest rate pressure, or they put the decision off last year and they've made the decision now? No one would really know why the stock levels are truly so much more elevated this autumn than what they were last year. I think in winter it will follow a seasonal trend where stock will tighten, buyers will have less choice. The spring market's a little bit more difficult to assess this year because if there are going to be rate cuts, it's predicted that those rate cuts will probably flow somewhere from August through to Christmas. And if there is easing of interest rates, that will give some people who might otherwise come to market with their listings a little bit more runway. So I think the listing flow is going to be in sync with what interest rates do or don't do. And there's no doubt that there's not one reason why stock levels are so elevated to begin this year, but one of the many contributing factors is that November rate rise from late last year.
So given that the topic of this little section is timing the sale, Peter, I'm going to put you on the spot. If you had to sell your house in 2024, I'm talking about you personally, when this year, from now till December, would you think is probably the best time for you to maximise your campaign result, but also reduce the amount of time on market?
Well, history will only tell us what is the best time of year to have sold in a calendar year when we look back on it on December 31. But I've never been a fan of spring selling. I think I've been pretty... it's not that you can't get a good price in spring individually, but as a real estate agent over a long time, I have always felt that spring was an overrated selling season. If I had a home that was not, in my personal view, presenting really poorly and at its worst in winter, I'd be comfortable with a winter sale. But in saying that, there is some reasonable confidence in the market now. So I think a post-Easter sale and probably somewhere after the school holidays in April is when I'd look to go.
Not bad advice at all, Peter. As we move to wrap up today, I would love to just get around and do our usual market wrap. You mentioned 1,300 properties went under the hammer or went to sale this week. Can you give me a sense of what the clearance rates have looked like and how they do compare with last week and this time last year?
Last week they were 56%. On the weekend just gone, they were 54% from around 1,300 auctions in both weekends. So, yeah, volumes are holding steady and clearance rates are holding steady. So I think that's a pretty good result.
Yeah, it sounds, I can't remember exact figures, but I think 54 to 55% was roughly what we had last week as well. So it seems to me like there is a pretty consistent number of listings and sales occurring week on week at the moment.
Yeah, and what's interesting is that more sold under the hammer last weekend than sold prior. That's the first time we've seen that in probably a month, actually.
I was going to say maybe the first time this year. I also noticed in REA's data, they talked about how I think it was 1,800 properties went to sale last week, not at auction, which still says to me that if they're closing out roughly 1,300 going to auction and 1,800 not, then still there is, one, there's a lot of strength in the market, but two, there's also a lot of people who are opting not to go the public route for their sale. Would that be fair?
Oh, that's very fair. Negotiated transactions have always outnumbered auction sales, but auction sales tend to draw the most publicity, which is why they get spoken about the most. They have higher advertising campaigns. They're a transparent street theatre, if you like, where people can turn up and watch it. So that's why they draw a lot more commentary. But yeah, if you're a pure data analyst and you're saying, well, how do most people choose to transact or end up transacting on their primary assets in the property market, it is by negotiation.
Certainly lots to digest this week, Peter. I really thank you for coming in and taking the time to talk with us.
Thanks, Kieran. Great to see you.
And thanks to everyone for listening to Current Market Insights. We look forward to talking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.